A $10 trillion deception. That is the price the market might have to pay for the current AI frenzy. Silicon Valley is quietly selling off while you are draining your wallet to buy in at historical peaks. Welcome to today's special strategic report. We are not talking about surface-level news. Today, we will dissect the black swan that is currently camouflaged under the glamorous shell of artificial intelligence. Let's start with a brutal truth. If you feel like an investment genius because your account has doubled thanks to Nvidia or Microsoft in the past year, be careful. In a bull market, everyone thinks they are an expert, but financial history over the last 300 years shows that. When taxi drivers and housewives start discussing tech stocks, that is when the death knell of a growth cycle begins to ring. We are standing on the threshold of .com bubble 2.0, and this time, the scale of the collapse could make the year 2000 look like just a minor scratch. To understand why your wallet is in danger, we must look back at the past. History does not repeat itself, but it always rhymes. Let's travel back in time to the 19th century with the railroad fever, and more recently to 1999 with the internet craze. In 1840 in England, the railroad was the technology changing the world. It was the AI of that era. People believed railroads would open an era of eternal prosperity. Billions of British pounds were poured into building tracks to places. No one needed to go. The result? The bubble burst. Thousands of banks went bankrupt, and the latecomer investors lost everything. In 1999, the internet appeared. Cisco Systems became the most valuable company on the planet. People bought anything with a .com suffix, a blind belief that this time is different. But the ending was the same. The Nasdaq evaporated 78% of its value. Those who bought Cisco at the peak in 2000 had to wait 20 years just to see their accounts break even. 20 years of dead capital. Can you imagine how massive that opportunity cost is? And now, 2024, 2025, we have AI. The old story is dressed up in a flashier new coat. The big tech corporations are racing to burn hundreds of billions of dollars on infrastructure, on expensive GPU chips, and on massive data centers. Wall Street calls this the fourth industrial revolution, but I call it race to the bottom in profit margins. Why do I say that? Look at the P to E ratio, price to earnings. Companies related to AI are trading at unimaginable valuations, reflecting an expectation of perfect growth for the next 10 years. The market is pricing them as if AI will immediately replace the entire workforce and generate massive profits by tomorrow. But what is the reality? Revenue from generative AI is currently just a grain of sand compared to the massive capital expenditure, or CapEx, that these companies are spending. We are seeing a horrific imbalance between expectation and reality. But here is the scariest part, the part that mass media rarely tells you. That is the action of the insiders, insider trading. While you are feeling FOMO, borrowing on margin to buy more tech stocks, what are the CEOs, the founders, the people who know the health of their businesses best doing? They are selling, and they are selling at record speed. Look at the insider trading data. Mark Zuckerberg of Meta, Jensen Huang of Nvidia, Jeff Bezos of Amazon. They have sold off billions of dollars in stock recently. Why? If they believed their companies would grow another 5 times or 10 times thanks to AI, why would they rush to cash out their profits right now? The answer is simple. They know the valuation has gone too far beyond the intrinsic value. They are the smart money. They understand that every party must eventually end. They are transferring these hot potatoes, stocks valued in the stratosphere, into the hands of naive retail investors, people who are being hypnotized by the rosy scenarios painted by the press. This is a massive transfer of wealth from the pockets of the crowd to the pockets of the elite, and it is happening right before our eyes. Another technical factor we cannot ignore is market concentration. Never before in history has the S&P 500 depended so heavily on such a small group of tech stocks. The Magnificent Seven are carrying the entire market on their shoulders. This is extremely dangerous. It is like a skyscraper built on fragile pillars. If just one of these pillars shakes, for example, a disappointing financial report from Nvidia or Microsoft, the building will tremble. And when it collapses, the domino effect will drag your entire portfolio into the abyss, regardless of whether you hold AI stocks or not. We also need to talk about the yield illusion. Companies are spending capital, CapEx, at unprecedented levels to build AI data centers. But the question is, who will pay for these AI services to recoup those costs? End users? Businesses? Currently, the excitement exists, but the ability to pay and the actual adoption rate remain big question marks. Goldman Sachs and Sequoia Capital have recently had to raise warnings about this issue. They question the $600 billion hole, the amount of revenue needed every year just to break even on current AI investments. That number is nowhere to be seen. When the market realizes that AI is not a magic wand that prints money instantly, but rather a long-term war of capital attrition, disappointment will set in. That is when the bubble bursts. So, how will the collapse scenario play out? It will not start with a big bang. It will start with doubt. A few earnings reports missing expectations. A few AI projects canceled due to inefficiency. Bond yields rising, reducing the appeal of growth stocks. Smart money starts to withdraw quietly. Stock prices begin to slide, slowly at first, then in panic as margin calls are triggered en masse. When the crowd realizes they are the greater fool left holding the stock, the exit door will become too narrow. Liquidity will evaporate. You want to sell, but no one wants to buy. That is the prospect of a modern flash crash. However, and this is the most important part of today's report, I am not here just to spread fear. I am here to hand you a treasure map, because in every crisis, life-changing opportunities always appear. The dot-com bubble bursting in the year 2000 wiped out garbage companies like Pets.com, but it also created a once-in-a-millennium opportunity to buy Amazon, buy Apple, buy Microsoft at bargain prices. AI is real. This technology will change the world, just like the internet did. But the real winners are not the ones being hyped up today. The winners will be the companies that survive the upcoming AI winter. Companies with real cash flow, with sustainable business models, and most importantly, bought at reasonable valuations. So you, the intelligent investor, what do you need to do right now? First, check your portfolio. If you are holding too many hot tech stocks, consider taking partial profits. Cash out like the CEOs are doing. Do not let greed turn paper profits into actual losses. Cash is king at this moment. Hoard a large amount of cash, ready like a patient hunter. Second, absolutely do not catch a falling knife when the market starts to correct. Do not think a stock down 10% or 20% is cheap. In a bubble collapse, prices can be divided by 2, by 3, or even by 10. Remember the lesson of Cisco. Wait until the panic reaches its peak when people on TV say, the stock market is dead. When your friends swear they will never play stocks again, that is when you step in. Third, learn to distinguish between the shovel sellers and the gold diggers. Currently, Nvidia is the shovel seller, selling chips, and is winning big, but when the gold rush cools down, the demand for shovels will drop. Look for companies applying AI to truly increase productivity in traditional industries like healthcare, energy, and manufacturing. Those could be the hidden gems for the next cycle. Fourth, do not fight the Fed and do not ignore the macroeconomics. Interest rates are still high. Cheap money is no longer as plentiful as in 2020. All asset valuations must be discounted according to real interest rates. If inflation returns, the Fed will not save the stock market. They will prioritize price stability. Do not expect an early bailout package, QE. In summary, the big picture is very clear, but also full of traps. We are living in a period of irrational exuberance. AI is the future, but current AI stock prices are a deception. Do not let the fear of missing out, FOMO, turn you into a victim of the Wall Street sharks. The financial market is a device for transferring money from the impatient to the patient. Be the patient one. Let others get drunk at the dying party. You stand outside, observe, sharpen your weapons, and prepare for the biggest hunt of the decade when this bubble explodes. History will name those who know how to restrain themselves today and dare to act tomorrow. As for you, will you be the one cashing out in glory or the one staying behind to wash the dishes when the party ends? The choice is in your hands.